to check the box here for View Position Analysis. At first you might not want to do this. It adds 6 columns over onto the right, which I feel help analyze a position. They help me analyze a position. So if I scroll over to the right, what this does is gives me a view of the entire position rather than each leg. So I have my original position cost, stock plus put, including commissions, $56.79. The original expected gain or loss. If you're trading a covered call, you'd see a percentage here of maybe 3%, 3.5%. But on a married put, we have unlimited potential upside profits. We don't have an original expected loss, so we're shown not available. The liquidation value, well, it'd be about $14 cheaper. We'd have a $14 loss on the position, mostly due to the bid-ask spread on the put. And then, of course, the future expiration value. If we held it all the way to expiration and made no adjustments, well, since the stock's trading below our put strike price, we'd have that full maximum loss of 3.2%. So this allows you to evaluate the married put as one position. On 216, we made some adjustments to on 616, we made some adjustments to a Cognizant Tech position. You see here it increased our effective cost per share from 47 up to 52.48. I believe I did income method number 4, and you see here now my liquidation gain would be 15%, and if I held it to expiration right now and the stock was trading at the same price, it would be around 13%. So I can run my analysis using this view. When I'm analyzing a position in my portfolio, married put position in RPM specifically, when I first open the position, the first thing I look for is, let me clear the draw. Let me clear up my original highlights first, and then we'll come back over it. There we go. What I first look for in my married puts, here's a Campbell Soup position. This one actually expired. I was going to do an adjustment with it during last week's presentation, but we didn't get to it. But I first look at this gain-loss column here on the right for the stock. The top one is always the stock. We see Campbell Soup has moved up 12.5, Cognizant's up 25.7%, El Paso Pipeline's up 1.8%, Kimberly-Clark has moved up 5.2%. Now what I'm looking for in this gain or loss column is once a stock has moved up about 5 to 8%, that's when I'm going to link to that position analysis screen to view a potential rollout opportunity. Yesterday, during the presentation, Kurt opens a RPM on Fossil, F-O-S-L. I bought stock, I think, around $47, $48 per share and bought a 55 strike put. I can't remember what his initial risk was. But what I did before the presentation, this was a position, I was in an RPM actually on Fossil that I opened in June or July, and I actually closed it in August because it matched my goals. But I went back historically, and I took a look at what the Fossil position was trading on August 5th and what married puts existed, and we put those into a portfolio. So I'm going to pull up this Fossil historic portfolios, and I have 2 married puts listed here. The first one opened on 8/5. The closing price for Fossil was $41.45, and at the time I could have bought a March 50 strike put for $10.80. Well, stock has moved up 17.5%. It's currently trading at $48.69. We see we have a 5.6% liquidation if we liquidated the married put right now, and of course if we hold it to expiration, we'd have the 4.3% expected loss on the position. Well, this one was deeper in the money, bought stock at 41, went about 9 points in the money to buy the 50 strike put, and we had a relatively low risk. Let's analyze that position where we stand right now, and to do that, I'll go into position actions and then position analysis. The position analysis view, hold on one second here. Let's see, is this the right one? I think this is. Sorry about that. Let me pull this up here. The position analysis, there we go. It opened up in the separate window for me. The position analysis view gives us a breakdown of our original position, stock at 41.45, 50 strike put at 10.80. Total invested was $52.25, roughly the break even. And when we opened the position, we had a risk of $2.25, or 4.3%. As I scroll further down on the analysis, this was the deeper in the money 50 strike put. We could liquidate right now for a 5.6% gain after 27 days. And if we held the position all the way to expiration, didn't make any adjustments, and the stock stayed at 48.80, we'd have a gain of about a loss, of negative 4.3%. The maximum risk for the position, But as I scroll further down, what we're shown now is some of the calculated rollout opportunities or income methods we could now do on this historic fossil position. If it was opened on August 5th at the price of $41.45 and we bought the put option at 1080, the 50-strike put option at 1080. Well, with the stock at 48.80, we're shown we could potentially sell the October 55 call for a premium of 40 cents. This would reduce our maximum risk down to 3.6%. We could also sell the September 50 call, which only has 17 days left to expiration, for about 80 cents. A little bit more premium, a shorter time frame, but we have a lower strike. So if the stock continues to move up, we might have to manage that in the next 17 days. Well, this would lower our risk down to 2.8%. It's good to see the positions numerically, but you might want to compare this graphically. What does my married put look like right now compared to what it might look like if I enter into this income method? To analyze that, click the More Information button next to the potential rollout opportunity, and we'll select Simulate Trade. This trade simulation tool, which is different from the trade simulator tool, but this simulation tool, over on the left, on the red, highlighted in red, we're shown our original position. Have a current return of around 5.5 to 5.6%, our maximum risk of 4.3%. If we sell the September 50 strike call, we'll lower our maximum risk down to 3%, but what we'll do is we will cap our gain. The maximum profit we can have right now is about $424, or about 8.2%. And scroll down below and we see this graphically. First, let me remove the blue and remove the black. Here's that standard hockey stick chart that we saw for the fossil position, the historical fossil position with the 50 strike put. Infinite maximum risk, current return of 5.5% if we liquidated right now. The curved black line that was on this chart, this shows us what the profit and loss chart for our married put position as it exists right now would look like on September 21st. Why September 18th? Why September 18th? Well, that's the expiration day. That's what we want to compare our position to if we were going to sell the September call. So let me add the blue line back in, and now we see the green line is showing us where the current stock price is. Stock has, if we sold the 50 call this, we would cap our gain at the 50 strike. If it continued to move up after that, we'd still make a profit, but we wouldn't make the maximum profit of $424, or that 8.2% we saw in the blue shaded analysis. Why is it important to look at this graph? What if my expectation going forward for the next 17 to 20 days is that I feel comfortable that fossil is going to continue to move up, and it might be trading up near $51 or $52 per share? I probably wouldn't want to enter this income method right now. Just because an income method is available or it's shown on the analysis screen doesn't mean I want to jump right in and take it. I want to review